Hey, good morning, options traders. Well, I get asked a lot about rolling. Rolling is a really powerful technique, one of the most powerful you can do as an options trader. It's one of the best advantages we get of using options over shares of stock. But within this whole category of rolling, there's a lot of fascinating strategies you can do. And one that I use a lot and teach a lot to all, especially to the new traders, is to sell half and roll half. So what does this mean and how do you benefit? So first, let's do a quick review of rolling. Remember that rolling means, for instance, let's say that you buy a $50 call and the stock moves higher. All right, so your $50 call has now gotten more valuable. What you're going to do is you're going to sell it, but rather than selling it to close and just getting out of it completely, you're going to take that cash and buy a higher strike, maybe the 55. Now you can do this much more efficiently by selling the 50-55 vertical spread. And whether you do them individually, meaning you sell the call and then buy the 55 as two separate trades, or whether you do them as a single trade as a vertical spread, it's going to generate a credit into your account. And the reason for that is that the $50 call, the lower strike, always must sell for a higher price than the 55. That's just part of the basic option pricing principles, and that will always be true in the market. So we know that whenever you roll up in this case, meaning we've rolled from the 50 to the 55, you're going to generate a credit. However, when you place this vertical spread and it executes, the sale of the 50 call is going to close your initial position, and the buy of the 55 call is going to open it. So once that 50-55 vertical spread executes, you're just going to shut down the $50 call and swap it out for the 55. So here's a little bit easier way to see it graphically, rolling the call up. Here's your long $50 call that you started with, and in one trade you're going to place the sale of the 50-55 vertical spread. These two trades right here is the short vertical spread. So when this trade executes, notice that your long $50 call cancels against this short. So the only thing you're left with is the 55 call, but you generated a credit. And so what you're trying to do is just continually walk along as that stock price moves up higher and higher and continually sweep credits into your account. Now I've also talked about when to roll. So again, as a quick review, you basically want to roll if that short vertical is trading for 80% of the difference in strikes. So in this example, if you have the 50-55 vertical, that's a $5 difference in those strikes. So 80% of 5 is 4. So you would want to roll when that 50-55 vertical is trading for about $4 in the market. It's trading for 80% of that difference in strikes. So here's what it might look like. Let's say that your initial position was to buy the $50 call for 6. 6 is the maximum that you can lose. And that's why your profit and loss diagram flattens out down here at 6. So once you've bought it, what are you going to do? You're just going to watch that 50-55 vertical spread. So let's say in the market, we see it's trading for 275. It's not ready to roll. It's trading for 3, not ready to roll. 375, getting closer. And then one day, it's trading for 4. Now we place our order. And when we do it, we will now receive $4 cash back, which offsets the 6 that we initially spent. So now I've switched from this red line to the blue. Notice that I've shifted my red line up to the blue by the $4 credit. So now the maximum loss is right here in this red box. It's just that $2 loss. Well, that's a whole lot better than 6. But I could still end up with a loss. But if I get another roll in, maybe I could shift from the blue to the green. So notice now, when I've shifted from the blue to the green, I have a guaranteed $2. I can't lose. That's why this green curve, this whole area here, as shown by this green box, is above 0. Now that's all good on paper and it's still an invaluable technique, but the problem is it might take a while. You might have to do 2 or 3 or 4 or 5 rolls before you can get yourself into this guaranteed profit. So this is where the technique of selling half and rolling half comes in. Now to speed things up, I've taken these prices from a pricing model But rather than stepping you through, I'm just going to throw the prices up here on the slides. So let's say that you start out by buying 10 $50 calls that are trading for $3. That's a total cost of 3,000 bucks. Now later the stock price moves to a point to where that $50 call is trading for $5.50. Well, rather than rolling all 10 calls, what you can do is to sell half of them. Sell 5 of them to close. That's just a straight up sale. And when you do that, you're going to get a credit of $2,750. And that's just because you're receiving 550 bucks total for each call times 5 is $2,750. So notice in one transaction, you've received $2,750 of your initial $3,000. You've almost gotten all of your money back. So what will you do next? Now you're going to roll the remaining 5 calls. So based on these prices in a pricing model, that roll would be worth $3. Now, yeah, I know earlier I said that we'd like to get a credit of 4, or 80% of that difference in strikes. But we're allowed to be flexible, especially if it gets us into a point of guaranteed profits. So sticking with these prices, we would get $3 for the roll. I'm going to roll the other 5 contracts, and that generates a $1,500 credit. So now I've put $2,750 in my pocket plus $1,500 in my pocket. I've got $4,250 sitting in cash, locked up safe. And when I offset that against my $3,000 initial cost, that means I have a guaranteed profit of $1,250. I cannot lose this. But I still own 5 calls free and clear to make more money. So this is what it looks like graphically. This red line represents my initial 10 calls purchased for $3 each. That's a total of $3,000. Now notice I've changed my scale here from the cost per contract to total dollars. And I had to do that because we're going to shift from owning 10 calls to 5. All right, so I've got $3,000 into the position. Now when I sell 5 and roll 5, I shift from the red to the blue. So notice this little wedge right here. Everything on this blue curve sits above 0. That's my guaranteed $1,250. I simply cannot lose, and that's in one transaction. And I didn't even need the stock price to move all that far to do it. Now, is there a trade-off? Sure. Notice the slope of this red line is much steeper than the blue. And that's because on the red line you have 1,000 deltas, and on the blue line we've got 500 deltas because we only own 5 calls. But like all strategies, it's a trade-off. So it's not a bad deal though. We've got a guaranteed gain, we've guaranteed to grow the portfolio, and we still have the potential for unlimited gains. So anytime that you buy options and the stock moves in your favor, consider selling half and rolling half. Do your calculations and see if you can get yourself into a guaranteed position. And the real benefit is that now the fear is removed. Now you can kind of afford to swing for the fences and hold out for those really big profits, because even if these final 5 contracts go up in smoke, we still have a guaranteed gain to show for it. If you'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.